at its core, debt finance is about raising money by borrowing. So just like an individual might go to a bank and take out a loan to buy a car or a house, companies and financial institutions and even governments often borrow money to finance their business needs, their cash flows, and their strategic objectives. So looking at debt finance as a whole, there are two main ways to do this. The first would be through a loan from a bank or a syndicate of banks. That falls within the practice area of bank finance. The second way is by issuing debt instruments, which can take various forms like conventional bonds or sukuk. So when a company issues a bond, it's essentially saying to investors, lend me this amount of money and I will pay you interest over time, and then I will then repay the full amount on a specified future date. And as lawyers, we help structure and document these arrangements to ensure they align with the commercial intentions of the parties, the applicable regulations, that they contain the appropriate investor protections.
Welcome back, everyone, to another episode of 20-Minute TC. I'd say I've been very excited about this podcast for some time, partly because I know how good a speaker Ola is, and partly because I know so many aspiring lawyers find it stressful to talk about bonds. So we're very lucky to be diving into the details of debt finance today. First of all, thank you so much for joining us, Ola, and I'd love for you to just briefly introduce yourself.
Thank you very much, Jason. So my name is Ola Sanni, and I'm a senior associate in the debt capital markets practice at White & Case, based in the Dubai office. So I originally trained in the London office of White & Case, where I did seats in capital markets, bank finance, and corporate private equity. And before moving to Dubai, I previously completed secondments at our Frankfurt and Abu Dhabi offices. So in my current role, I mainly specialize in debt capital markets, which I'll be going over in a bit of detail today. And that basically refers to the issuances of, conventional bonds and Islamic finance debt instruments. So that's essentially what I cover.
Perfect. And as you said, I want you to imagine I know nothing about this phrase, debt capital markets. How would you explain that or like debt finance to me?
Yeah, sure. So at its core, debt finance is about raising money by borrowing. So just like an individual might go to a bank and take out a loan to buy a car or a house, companies and financial institutions and even governments often borrow money to finance their business needs, their cash flows, and their strategic objectives. So looking at debt finance as a whole, there are two main ways to do this. The first would be through a loan from a bank or a syndicate of banks. So that falls within the practice area of bank finance. And then the second way is by issuing debt instruments, which can take various forms like conventional bonds or sukuk. So when a company issues a bond, it's essentially saying to investors, lend me this amount of money and I will pay you interest over time, and then I will then repay the full amount on a specified future date. And as lawyers, we help structure and document these arrangements to ensure they align with the commercial intentions of the parties, the applicable regulations, and that they contain the appropriate investor protections. So that's, a very general way to summarize what we do.
That's perfect. And I want to double down on your explanation of bonds, because I think there are probably a few terms that I notice people going into law struggle a lot with, and bonds are especially one of those terms. Are you able to just re-explain or explain again, like what is a bond?
Of course. So a bond is essentially a tradable debt instrument. So think of it as a form of IOU from the borrower, which is referred to as the issuer, to investors. Right. So a bond will comprise of different terms like the principal or the face value amount, the coupon or the interest rate or amount, the payment frequency and maturity date. All of these are packaged into an instrument called a bond. And what makes bonds quite unique is that they are transferable, meaning investors can actually buy and sell them on the market before they mature. So they are a liquid form of debt instruments. So unlike a loan, that's usually between two parties, or between the borrower and the syndicate of banks. Bonds can be traded, for instance, on exchanges by multiple investors. So they are quite a flexible and widely used way to raise capital globally.
Perfect. And what are the types of bonds out there?
The types of bonds, so there are many types of bonds, but if I were to summarize them, broadly speaking, we can include corporate bonds, which are bonds issued by companies. You have sovereign bonds, bonds that are issued by national governments. You have, Islamic bonds, even though that's not the official term. We have the sukuk, instruments which are, essentially a debt obligation that is structured to comply with Sharia or Islamic rules, typically backed by tangible assets or contracts. And in terms of the different features of bonds, again, you'll see fixed rate and floating rate bonds, depending on whether the interest rate amount is, static or just, by reference to the interest rate or a certain benchmark. You can have green or sustainable bonds, which are bonds where the use of proceeds is basically used to fund environmentally or socially impactful projects. You have high yield bonds, which are issued by issuers, with a slightly lower than investment grade credit rating, so they can offer higher returns but slightly higher risk to investors. And you have convertible bonds, for instance, which can be converted into shares, under certain conditions. So, as you can imagine, they are an instrument that can be catered towards different commercial scenarios and different business needs.
One thing I've always, not always, but it used to be quite confusing to me is the relationship between bond prices and bond yields. And I think we talked about this before this, but this is where we start to bring commercial awareness into like real life. And you can see often in the FT, there's like something happens and then it impacts whether it's bond prices or bond yields. Can you just talk a bit more about that relationship?
Yes. So essentially, this is a fundamental concept, So, what people need to understand is bond prices and the yields typically move in opposite directions. So, for example, let's say a bond pays a 5% fixed coupon or fixed interest rate. If the interest rate rises, i.e., the central bank interest rate were to rise and the new bonds are now issued, which now pay 6%, the previous 5% bonds become slightly less attractive to investors. So the price of that bond might drop, right? Which also means like that the yield would then increase, right? If rates were instead to fall, for instance, the 5% bond, which is now, higher than, whatever the relevant central bank base rate is, becomes more attractive relative to that. So the price increases. So a good way to understand this is, the central bank interest rates essentially sets the floor of how a lot of these debt instruments are priced, right? And that would affect how attractive and unattractive a certain instrument is, and which will also affect the price and the yield on the market. Since, as I mentioned before, these are instruments that are traded, and investors would often look at these factors, when deciding to buy or sell the bonds.
Perfect. Those are really clear. I think it often comes up in this podcast, this idea that a lot of these points eventually come down to this idea of how can I make more of a return for my money? And as in this case, it's like investors, are they going to jump to newer bonds that are going to pay more interest or stick with the existing one? That's very clear. You mentioned at the start, there's like two types of debt, ways of raising money via debt. You said bonds and then loans. Why would I opt for issuing a bond as opposed to just going to a group of banks and getting a loan?
Yeah, that's a good question. So I would say that there are a few key advantages that makes bond issuances quite attractive to investors and issuers, particularly for larger and more sophisticated borrowers. I think the first that I would say is scale and access. Right, bond markets give issuers access to just a wider pool of investors across different jurisdictions which can mean, if an issuer wants to borrow a much larger amount, they're able to do so by raising bonds rather than bank finance or even syndicated bank finance, in which, at most you may have 10 or 12 banks participate in a deal, whereas on a bond issuance, you can have literally hundreds of institutional grade investors, right? Which just allows for raising much more capital. Another key kind of feature that makes bonds attractive is just the longer tenors, right? So bonds can allow issuers or borrowers to lock in funding for potentially much longer periods of times than you would otherwise see in bank finance, and sometimes up to 30 years or more, which is just, you often would not see that, in direct kind of bank financing. And then just finally, I would say the cost and the flexibility. So depending on market conditions and, the credit profile of the issuers, pricing for bonds can be more competitive on average than traditional loans. Bonds can be structured, with different features, as I mentioned before, fixed, floating, callable rate, or even convertible, to match the commercial needs of an issuer. The covenant package for bonds on average tends to be slightly lighter than with bank financing. But I would say, that said, bonds do involve a lot more upfront work and legal documentation, investor disclosure. For instance, a prospectus might be required in some instances, ratings and listing requirements. So it's, in terms of process and documentation, there is a lot more work up front, but over the long term, due to all the features I've mentioned, it can be a more efficient route and a flexible route for borrowers to raise funding.
It nicely leads on to my next question, which is, we're sometimes, I think, maybe gets lost is we're talking about debt finance, but you're not trained to be a finance person, right? You're a legal advisor, and I'm really curious to know more about the role of a debt finance lawyer. I'd love to know if I imagine someone comes to you, they want to raise money via a bond, what is the process like from the point at which they come to you all the way to the end? How would you talk through the role of a lawyer in that situation?
Of course, great question. To try my best to summarize it, we essentially guide the client throughout the full cycle of an issuance, right? So, what this might look like in tangible terms, let's take the example of a straightforward bond issuance for conventional bonds. At the very start, you would have a kickoff call whereby all the different counterparties, in a bond transaction will come together. So the issuer, i.e. the company that's actually trying to raise finance through the bond issuance, the banks who will tend to underwrite the issuance and then, pass it on either on their own books or to their own clients. You'd have the legal counsel. So you'd have, the issuer's legal counsel, and then the banks would also be represented by legal counsel, the auditors, the relevant agents who perform various administrative functions for a transaction. They will all jump on a call to coordinate and agree what the timeline will look like, the processes. And then you then go on to drafting. After the kickoff call, the drafting of the key documentations would then start. So if you're acting for issuers counsel, you'd be responsible for drafting the offering document, the prospectus, which includes various disclosures around the bonds itself and the issuer, the risk, the key risk factors, their financials, etc. The bank's counsel would often take the lead with drafting more of the technical provisions in the prospectus, as well as taking the lead with the transaction documents. The transaction documents will be negotiated and finalized, with the input of counsel and the banks and the issuer. Some of these are really tightly negotiated, like the sub agreement, where there's certain reps and warranties and indemnities that the issuer would need to comply with. So those tend to be, like, the more commercial terms tend to be heavily negotiated. If the bond is listed, then there will be an element of liaison with the stock exchange sending certain documents for their review and coordinating with them to make sure they are aligned with the timeline. You would also have to liaise with the clearance systems, which are basically entities that facilitate the settlement of bond transactions internationally. And then towards the end, you'd have the signing and closing where the bonds are issued, the funds will flow from investors to the banks to the issuer. Securities are listed if it's listed, and they will be admitted to trading. And then, of course, post issuance, the lawyers will also support, with various continuing obligations. Right. This is a very high level summary, but that is essentially what it looks like.
Perfect. You mentioned the prospectus, which I I maybe know more from that equity capital market side. Like that's where I often hear prospectus. Here's my question: is that like the main legal document, and are there any like key legal documents that are missing? And are you also able to just briefly explain what those are?
Of course, of course. So the prospectus, how I would describe it, it's less so a legal document. It's more a disclosure document, that is provided to investors, right? Which basically sets out the key information that that from the issuer's perspective, the investors need to know about the issuer, about their management, about the key risks relating to the issuance, about their financials, and the terms and conditions of the bond itself, right? So it's more so a disclosure document. In terms of the actual transaction documents that are involved in a bond issuance, I guess the key one, which I hinted at earlier, is a subscription agreement, which is entered into between the issuer and the banks on the deal, and it governs the arrangement between the issuer and the banks, including the pricing, the fees, any condition precedents, i.e., the CPs, and the conditions that need to be met before the obligation of the banks to actually underwrite the issuance will kick in. You would have a trust deed or a fiscal agency agreement, depending on which structure is being used, which will outline the rights of the bondholders, how they can be enforced. You have the legal opinions as well, which is typically then provided by counsel for the issuer, who would provide a capacity and authority opinion, just kind of confirming that, hey, look, we are representing the issuer, and in our view, the issuer has the relevant corporate authorizations and the capacity and authority to enter into these transactions. Whereas the banks will provide a legal opinion, basically confirming that the transaction documents are enforceable, as per the relevant governing law. The auditors will also provide a letter. They'll provide a comfort letter because, as I mentioned earlier, the prospectus will include financials which are derived from the financial statements that are prepared from the auditors. So the auditors will need to provide a letter of comfort to the banks, confirming that the financials are accurately derived and from the audited accounts. And then there will be some listing documents that are shared with the relevant stock exchanges, as well as documents sent to the relevant clearance systems. So it is quite a paper-heavy process, but each document plays a really key role, in just how these transactions are structured and providing comfort to the relevant party.
Perfect. Yeah, and it like from my side, it just shows why lawyers are needed. If you've talked about how extensive that process can be, how many documents there are, it puts a lot of clarity as to why you need lawyers to draft the things in place to have those protections. We've also mentioned quite a few terms that I think many people that would be hearing for the first time, whether that's prospectus or conditions precedent, although I know that applies to different types of legal rules as well. Are there any technical terms that are maybe quite specific to debt finance that you wouldn't otherwise know about unless you became a debt finance lawyer?
Of course, I would say, it's funny because you like, even as you go along, you come across new terms that you'll need to familiarize yourselves with. But I guess certain key ones that I would flag to students, or the common ones, are SPV, i.e. a special purpose vehicle. We often see that on structured finance deals and in many Islamic finance deals. It's basically whereby the company that's actually borrowing and wanted to issue bonds is doing so indirectly. So that the direct issuer will be a blank shell, empty, company that's often incorporated, we see very often like in an offshore jurisdiction, and it's essentially done just to segregate the credit risk of the direct issuer from the borrower. So that is a concept that we see very often in structured finance deals and in Islamic finance deals, where just the structure of those deals demand that level of segregation. You have tranching, which is another concept whereby where you split the capital structure of the securities into different layers of risk and return. Again, we see that more often in structured finance and securitizations. You have the waterfall, which essentially is the priority of payments to note holders, the agents, and the various other stakeholders. So you would often see that in, for instance, a trust deed or the fiscal agency agreement, which basically just sets out what the priority of payments will be. And then you have a true sale, right? Again, it's a legal term that you see in structured finance and sometimes in Islamic finance transactions. And it's a legal term used to just to capture the fact that the transferred assets are no longer part of the originator's estate in insolvency, and they are, regarded as being bankruptcy remote. In Islamic finance, I think that there's an entire new dictionary of specific jargon, which I will not get into.
No, that's great. And often I say to students, it's like we'll hear a lot about these technical terms, and even with this podcast, the more episodes you listen to, the more you like immerse yourself in this, you pick stuff up over time. And if this is the first time hearing them, it may be new, but then you'll keep hearing them until they do click. Now, we had a interesting conversation beforehand about this like thing about how does this play out in real life. And I think many students get asked about commercial awareness, and it's sometimes not clear, even for me often, is like, okay, but why do, like, in terms of as your role as a lawyer, why does this actually matter? Is there anything you could say a bit more about, like, how does broader commercial awareness play a role in your role as a lawyer?
Of course, absolutely. So commercial awareness, to me, it's much more than just staying up to date with the news, right? In practice, it's about actually framing the delivery and the legal advice within the client's broader commercial strategy, whilst being aware of the current market environment, right? So in debt finance and in debt capital markets, what this looks like is making sure you're attuned to market dynamics, the client's financial objectives, the commercial interest of all parties involved, negotiation, of a transaction. So to give you an example on, looking at interest rates, for instance, a sudden hike in central bank interest rates can directly affect the pricing, the investor demand, and the like choice of the parties in terms of opting for either a fixed rate bond or a floating rate instrument. Right, that can have a direct impact on those terms. The credit profile of the issuer, i.e., the credit rating, if the issuer is under financial pressure, their credit ratings have recently been lowered, it can directly impact their leverage in negotiations with the banks, right, and the different parties. The banks may, for an issuer with a weaker credit profile, they may push for tighter covenants or more, robust terms and conditions or security even, which again, if you're, let's say, a counsel acting for the issuer in those circumstances, you would need to be aware of, where your clients or what your client's negotiating position is based on their credit profile, because that would affect how you determine whether the other side's demands are reasonable or not. Again, that is commercial awareness. So it's not just about knowing the headlines, it's about understanding these factors, understanding interest rate, inflation, geopolitical risk, credit considerations, and how they shape the day-to-day transaction decisions. And I would go as far as saying, even internally within a law firm, commercial awareness also means just being conscious of like how your time is built, right? How do the partners win the deals, and what matters to clients and partners, not just from a legal perspective, but also from a business sense, because that can affect how you deliver your legal advice. So I hope that kind of succinctly summarizes my view of commercial awareness.
Definitely. And it's interesting you mentioned the other side of that, which is how does it fit within a law firm? I guess one thing I notice is like, especially with finance for some reason, that finance can sit differently with different firms. And I find this side helpful to understand how law firms as businesses work as well. I guess, how does your practice area, so like debt capital markets, sit within Whiting Case's practice areas?
Yeah. So whilst arguably bank finance and debt capital markets are forms of debt finance, but at White and Case they're two completely different practice areas. There is, obviously a degree of overlap, in terms of our day to day. For instance, at White and Case within our debt capital markets team, we may occasionally work very closely with the bank finance team, particularly where issuers are pursuing parallel financing strategies. Some issuers, don't just opt for one or the other. Like they may opt for both, which means you need to coordinate very closely with the banking lawyers to ensure things like the covenants, the reps and warranties, and what the issuer is agreeing to on the banking transaction is somewhat aligned and is not too far off what they're agreeing to in debt capital markets, right? We also may work very closely with the regulatory team, which is a completely different practice area because, obviously with securities offerings, they can tend to be very, very highly regulated. So, you need to ensure that when executing these debt capital market transactions, you're doing so in full compliance with the rapidly evolving global regulatory landscape, right? So it is one of the firm's most kind of in demand practice areas globally. We have active mandates in the USA, in North America, in Europe, in the Middle East and Asia. Where it's a very busy practice area, and yeah, and the global debt market as a whole is a very large market. It's actually larger than the equity market because governments and companies very often when they want to raise capital, it's by way of issuing debt rather than equity in most cases.
Amazing. Yeah, I didn't actually know that, which is why I'm running this podcast to obviously learn more about gaps that I don't know. My last question is maybe more of a selfish question, which is I think sometimes I struggle to understand what stories are relevant to people going into the profession right now. And you obviously know best from the side of debt finance, debt capital markets about what trends have been happening in this space that are really like you think people should know. What comes to mind there about what's going on in the space at the moment?
Absolutely. I would say from my perspective, at least for my practice area, one of the key trends, the number one has to be global interest rates, right? Because it's one of the biggest drivers right now is the central bank policies around the world, around the interest rates. Because the global interest rates, as I said previously, essentially sets the floor for the interest rate on any new bond issuance, right? So as a result, I think the market and various stakeholders within the market are closely watching, where the rates are moving. Any downward shift, for instance, in the central bank interest rates can help issuers potentially lock in, more competitive pricing on their bond issuance. So I would say that's probably the number one. There are some other trends that are perhaps not as prevalent, but it's still worth being aware of. So green bonds and sustainability linked bonds. I think we're seeing increased focus in those areas. ESG globally, it remains quite a major theme. We're seeing more issuers are trying to finance, and raise financing, with the use of proceeds being used for environmental or social initiatives. So we're seeing increased interest and uptake in that. Islamic finance is also, I would say, increasing in prevalence. We're continuing to see a strong interest in Islamic finance, not just in the Middle East, but also globally. Whilst the traditional investor base for Islamic finance and sukuk issuances, have typically and still predominantly is, the Islamic banks and, your Sharia compliant funds. But we're seeing increased participation from conventional investors, conventional banks, who are looking to diversify their exposure and their investments, and they want more access and exposure to this market. So that is a trend that I've also seen that's been emerging recently.
Amazing. Well, thank you so much, Ola. I think you're probably the person I go to when it comes to anything to do with debt capital markets, just because of how clearly you explain things. And I think that's really provided a clearer understanding of like everything from bonds to the role of lawyers and like the whole process along the way. It's also given me reassurance about why I talk about interest rates, because it actually is relevant to what you do. And yeah, last thing, just to say, like, I think obviously we got to know each other, I think through SEO London, maybe like 10 years ago. And it's really cool that it's awesome to see, obviously, you thrive within this space, also moved internationally to a different office, etc. And so, yeah, I just really appreciate your time, and thank you for being involved, Ola.
Anytime. Thank you for inviting me.